Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the micro bearish WXY scenario where we have a flat in wave W, a zigzag in wave X, and now we're looking for a move to the downside in the wave Y. The most common target area for a wave Y is between the 1 and the 1.236, which is taken from the high of wave W to the end of wave W to the high of wave X, which is sitting between 33.1k and 32.7k. The 0.618 is a less common target, but a target nonetheless, sitting at 33.7, which also is in confluence with this support area over here between 33.7 and 33.9k. 1.618 all the way down here is more rare at 32k. Now, because wave W over here is then labeled a flat and then a 3, 3 and then a 5 wave move to the downside, wave Y is not allowed to be a flat, which is the reason for the invalidation over here, because in a flat you want to see something like this, but in a sideways double combo structure, wave W and wave Y cannot be the same structure. Therefore, we're either going to be looking for a zigzag structure or a potential triangle. Now, if we zoom in over here, then this looks very three-wavy at the moment. That could be a potential zigzag. The problem, of course, is it is not deep enough. So I'm curious to see how this is going to develop. But in this particular scenario, we are looking for the blue target box to be hit as a bare minimum. In this particular scenario, which is also a more bearish scenario, before then continuation to the upside, by the way, right? Same with the previous scenario here, we expect continuation to the upside to at least take the highs over here. In this particular scenario here, that's the same. However, wave B or wave X is not yet finished in this particular scenario, and we're still looking for a move to the downside. So here we then have wave A or W, B or X, Y or C, and then an ABC flat potentially, and then you want to see the 0.9 Fibonacci hit taken from the high to the low of W. You can only have a flat if wave B retraces to the 0.9 Fibonacci. So as long as price did not touch the 0.9, a flat is not really on the cards. And the wave X can also go above the high of wave W. So that is why in both cases an ABC or WXY is a possibility. But in a wave C, you want to see an impulse to the downside. And in a wave Y, you're going to look for a three-wave structure. Now, in this scenario, we are then still working on wave B or wave X. Wave W here is then a zigzag structure in an ABC or a three-wave structure here, zigzag, for then a flat in a wave X, and then because of wave Y not being allowed to be the same structure as W, going to be looking then for potentially another flat then in wave Y, meaning the blue target box over here will be hit again for then potentially a bounce to the upside to finish B or X. Most common target for the local wave B and the potential ABC is between the 1.236 and the 1.38, with the 1.618 being less common. And you can see it kind of involves the whole support area, the whole target box here between 33.7, 33.9. So that is quite nice confluence, Elliott Wave confluence with the other tools as well, for then a potential bounce in this area, which of course means observing the reaction. Whatever that it means for you, potentially market structure changes, bullish CVD, RSI, stochastic, moving averages, VWAP, whatever you like to use. Of course, you want to see some proof of resistance, proof of support, because if price comes down on volume and we're just going to do this, well, of course, we don't want to have any long positions here. So, we don't FOMO, YOLO, catch knives here. It's sensible, responsible trading. We observe the reaction and take it from there, whatever your plan says. Now, if we then look at the bullish scenario, then the bullish scenario, well, in that case, the low is in after a running flat. Now, a running flat in general is very rare, with an A, B, and then a wave C ending over here, for then continuation to the upside. And then we have three options for the impulsive scenario. And I always recommend going through these options if you're looking for price to move to the upside or the downside impulsively. First things first, a regular impulse, 1, 2, 3, 4, and then eventually a wave 5, where overlap between 1 and 4 is not allowed. Lots of overlap over here, so that is not on the cards. Then you have to think about a diagonal, so potential diagonal over here. Contracting diagonal is by far most common compared to an expanding diagonal, which is rare. So we need to see, okay, are the waves longer or shorter? Well, if I take a fib, trend-based fib from the low, to this high to this low, then you can see the 1-to-1 has been taken. So that wouldn't be allowed. If I take it from this high, then okay, it is shorter, right? So then we have over here potentially a wave 1, then we have a wave 2, wave 3, wave 4, and wave 5 over here is also shorter. So based on the fibs, you might say, okay, right, we could have a potential diagonal because the 1-to-1 over here is not hit, so each wave is shorter. But then the problem is, you take a channel from this high to this high to this low, and you can see that the low of the channel is hit, which is not allowed because you're looking for a contracting diagonal, so the lower trend line should converge towards the upper trend line, which is not the case because the channel has been hit, invalidating a contracting diagonal, and an expanding diagonal is very rare. So then you have a double potential 1-2, where this is your wave 1, this is your wave 2, but look at this second lower degree wave 1. Look how long it is, how stretched it is. It is also an expanding diagonal, so doesn't look good, of course. So the bullish scenarios are not looking good in this range, and the bearish scenarios have a higher probability at the moment. Now, if we look at this range over here, the volume profile is very, very interesting, as TXM also highlighted in Discord. This range has been very well respected from a volume profile point of view, where it's simply, as they usually say, trade the range until it breaks up, down, up, down, up, down. No financial advice, of course, but we reached the value area high once, moved down to, at that moment in time, not yet weekly naked point of control, move up, move down again. Actually, we did because this was Monday. So we actually just missed out on hitting it, move back up, move back down, hit the weekly naked point of control, back up to the value area high. And then we're on our way down again. The point of control over here is sitting at 34K with the value area high sitting at 33.8K, which is also part of the confluence area of this box, including these lows as well. So there's a nice little bit of confluence in that area. If we look at the CVD divergences, then zooming out, we have the bullish ones and the bearish ones, which makes it a bit confusing also because the AJGR highs that I use, so the CVD chart basically, which is this one over here, the highs on the left are different. So if I zoom out, you see here a lower high, but on my chart, this is a higher high, which makes it a little bit difficult to read. So both of these are still possible. So that is they are countering each other really. And more locally, we have the bullish CVD divergences over here, higher low in price, lower low on the CVD, but also with the little order block over here, we have a lower high and a higher high on price, which is a bearish on the CVD, which is a bearish CVD divergence. So you really want to see this high being broken for price to potentially continue to the upside and fulfill the bullish CVD divergences, as the target would be this high over here. Now we do know we bounced on the weekly naked point of control. We got a bit of structure to the upside and move to the downside bullish CVD. It's looking good, but you do want to break this bearish CVD divergence over here by at least taking this high, and then of course see what CVD does once we move towards the upside. So that would be a minimum, but if you can break this, probabilities increase to take the high over here for the bullish CVD to play out. If we then finally look at the probabilities of this range, then in general, right, when we zoom out and also look at the higher perspective, but in general, probabilities are high to take these highs at least once more and likely then move to 36K. But if we look at the range over here, then the two bearish scenarios shared have a higher probability at the moment of playing out, which kind of means you're eventually going to look for price to move to the target box. But it can take some time, because if you look at the length of A or W over here, for example, right, it can take some time. Also, the blue wave W is very long, so the blue wave Y can also take a while. It doesn't have to go and do this and be very short, right? It can be a three-wave structure, then eventually move down, then up, and then you go for the green Y or the green C. So time is important in Elliott waves. Also here, green W very long. So for the green Y, we don't have to do this immediately, right? It can take some time. But in general, the bearish scenarios, they do have a higher probability, which means that eventually we're going to be looking for this target box over here and then observe the reaction to see what scenario has the highest probability of playing out, but the most common target area for Y is down here. And if price moves to B or X, most common target area for Y and C is also going to be below the range, basically below the lows that we have over here. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.